Welcome to the Same Day Podcast, where we discuss driving incremental business growth and other topics related to real estate, property management, and entrepreneurship. Now, to the show at hand.
Hello, Yoni Schmidt here, hosting today's episode of the Same Day Podcast, where I connect with top business and real estate leaders. Past guests include Chip Gabarino, a local restaurateur entrepreneur, Elliot Nelson, Morgan Martin of Merrill Lynch, and many, many more. Today's episode is brought to you by Keyrenter Property Management. At Keyrenter Property Management, we are a full-service property management company helping our clients buy, renovate, and operate real estate assets. We help our clients build wealth while taking the headache out of property management. That is why no matter what asset you have, single-family homes, condos, townhomes, apartments, or anything else, we have the management solutions you need. Go to KeyrenterPMC.com or email us at info@KeyrenterPMC.com for more information. Today's guest is someone who truly embodies the phrase, live where you want, invest where it makes sense. Zach Lemaster is the founder and CEO of Rent to Retirement, the nation's leading turnkey investment company. A former optometrist and Air Force captain, Zach transitioned from medicine to real estate and has since built an impressive diversified portfolio spanning single-family, multifamily, commercial, and new construction properties in markets across the country. He's a seasoned investor, licensed broker, and nationally recognized expert whose insights have been featured on Forbes, USA Today, NBC, and many more. With a passion for educating others and helping investors design their ideal lifestyle through smart market selection and strategic real estate plays, Zach is here to help us unpack what it really takes to build wealth without sacrificing your time or location freedom. Welcome to the show, Zach, and thank you for being here.
Yoni, what an excellent introduction. That's fantastic. Thanks for having me.
Thank you. Let's just dive right in. You started your investing journey while you were serving in the Air Force, which, by the way, thank you for your service. I have tremendous respect for people who are in the armed forces. As a veteran of the Israeli Defense Forces myself, not a popular army at the moment on June 6th of 2025. But tell me a little bit about what sparked your interest in real estate during that time.
Man, I just wanted to be, Yoni, I think in my young career, because that was the first time I joined the Air Force immediately after graduating from optometry school because I was on scholarship, which was great. So I was immediately commissioned as a captain, and that was my first real actual paycheck that I received. And as I was learning about money, I just wanted to be smart with money. Real estate was something that I had kind of, read some books on, obviously the Kiyosaki stuff, and, just kind of started to get interested about what can I do with investing? The first house I bought, even, which I used a VA loan, I was able to put no money down, which is fantastic, was a duplex. Lived in half, rented out the other half. And then, that's where I got the bug. But I just wanted to be smart with my money. Real estate made sense. It's a tangible asset. I knew nothing about stocks. I wanted to be able to immediately have an impact to reduce my expenses, and kind of chase this financial freedom thing from the very beginning. And real estate just made sense. So honestly, that's it.
Yeah, love it. Tell us, I guess, a little bit about the biggest mindset shift that, it took you to go from being in medicine, because optometry is a pretty good industry to be in, as far as I understand, to investing full-time in real estate, right? Did you, have some sort of light bulb going off in your head where you were like, well, this makes a lot more sense than being a full-time optometrist?
Not really, actually. I would say it was a very slow transition, which is okay. I know there's some people out there that are looking to I want to be done yesterday. You know what I mean? And on that entrepreneurial journey, that wasn't me. I took the slow route, which there's nothing wrong with that. Real estate is a beautiful thing because it very much can be like a side hustle for a lot of people, where you can do that. And I honestly think that's the best way to approach it in the beginning, where you can still keep your job, have income to be able to qualify for loans, right? And have stable income, and then ease your way into real estate. Some people jump off the deep end. I got pretty heavily invested into real estate. I never looked back. And I started investing about 15 years ago. And I always tell people, since we bought that first duplex, every single year we bought real estate. not saying we made money on all of our deals, but every single year we bought real estate. But no, I was fortunate enough where I was able to like slowly over time reduce, because I was in the Air Force for 7 years and then I went into private practice. I was able to slowly reduce my hours in optometry as I, increased that and supplemented that with the real estate investing. And eventually about around years like 5 or 6, I like surpassed my income, which was a good income. But yeah, it was a slow journey. Although I did, there was one point in time where I was like, man, like with optometry, even it being in a business owner, and we own our own businesses and clinics because my wife's also an optometrist, like your income is kind of like capped or limited. It's limited on the amount of patients you can see, amount of people you can come through, your time in the chair. With real estate, it's like the sky's the limit, right? And it compounds every single year. And we're just like, that'd be cool. So, but I was never the situation where we disliked what we did. We're still passionate about helping people see. We do a lot of humanitarian stuff now. We're still licensed. It's just that, hey, we're able to not rely on that for income. So that was kind of the journey for me.
Yeah, I love that. I definitely want to go back to what you were talking about in a moment about buying real estate every year, especially in this very tight interest rate environment that is difficult. I love the fact that you are house hacking that duplex. In fact, that's how I started when I was, when I bought my first property in Tulsa. I was house hacking my personal residence, and I let 2 good friends move in with me. So it wasn't a duplex; it was a single family home. But I knew the guys before they actually moved in. But before we touch on how do you continue to expand during tight interest rate environment periods and in this economic environment, let's talk a little bit about how did Rent to Retirement come to life? What was the gap that you were trying to fill in the investment space?
Yes, I mean, this was a business, and we've just blown up today, because we've just been focused on helping others do the same thing that we did. Rent to Retirement was really birthed out of, the impetus was us just trying to find our own investment system that worked for this is my wife and I. We invested locally first, which there's nothing wrong with that. However, some people are, very limited to not be able to invest locally because maybe they live in an expensive market. Maybe the numbers simply don't make sense. The tax or legislation doesn't make sense. I would actually argue that most people, regardless of where you live, there's probably a better market out there for you to invest in based on your goals. But we basically invested locally, and then we were like, hey, we don't want to own a bunch of properties where we were living at the time, which was Grand Forks, North Dakota. I was there for the Air Force. I wasn't going to be there forever. It wasn't like this great market. So we started to strategically look at other markets that did make sense around the country. We made some investments. Went terribly. And then we improved our process and our systems of actually being intentional around identifying the markets that have the best opportunity, the best growth, that were congruent with our goals, building teams and systems in those areas to scale our portfolio and consistently diversify and then replicate that process in other markets. For our own portfolio, we had a lot of friends and family and colleagues that were like, hey, we see what you're doing in real estate. We don't have the time or the knowledge or the expertise. Like, can we invest with you? And we just help them buy properties following the same process that we already put in place. And so that was really the foundation of Rent to Retirement, is just helping people do what we did for our own portfolio. And of course, fast forward to today, we're doing thousands of transactions across 18 different markets, and we have a large investor base because we knew that, or we found out that there was a lot of people that would benefit from our services outside of just our own community. So we've been very fortunate that we've always approached it of like, what would we do? Because we're real estate investors, and then how do we help other people do the same thing?
Yeah, that's great. So let's go back to that buying every year, because, over the last, call it 2 years, let's say, interest rates have gone up. The economic environment has not been extremely favorable for investors who are looking for cash flow. And I get a lot of phone calls that people say, I'm looking for cash flowing properties. And my answer is always, well, anything will cash flow with enough equity in it. If you buy a house for cash, it will cash flow, right? It doesn't necessarily mean that your rate of return is going to be the greatest, or what your personal required rate of return as an investor, would be. But how are you guys doing it right now at Rent to Retirement, and how are you finding opportunities that make financial sense? Is it more about appreciation than it is about cash flow? Or am I looking at this all wrong?
Yeah, I think a lot of people, I have so much to say on this, Yoni, so cut me off whenever. I can be long-winded. But
Yeah.
first and foremost, a rent-to-retirement, there are markets that are still cash flowing today. And you're absolutely right. Sometimes with higher interest rates, like maybe you need to put more money down. Our average investor is putting 25% down on properties, and there's nothing wrong with that. Like that's just part of the deal. But most people think, I think early investors think that there's this spectrum of either cash flow or appreciation, and you have to choose either or. And that's not necessarily true in the right market. Now, yes, there's a balancing act of all these things, but there's a lot of markets, like for example, in the Southeast that we work, and we mainly do new construction. So our main asset class is like new construction, single family house or small multi, so 2 to 4 units in a growth market. Average home price is probably $250,000. That's going to yield an 8% cash on cash return if you're putting 25% down. Just on the cash flow, right? Not the appreciation and tax benefits, all the things. So there are markets that we are working into today that still have strong appreciation and they have positive cash flow, even at higher interest rates. However, I would say to answer your question, how we're combating a lot of the rates is that, we'll offer rate buy downs, right? I mean, that's a common thing a lot of people are doing, especially in the building space is, just we'll offer builder incentives to buy rates down. Where we're actually paying that into where people can get rates into the 4s or maybe low 5s where, hey, it does cash flow and it makes sense. And I would take advantage of that. However, my bigger picture philosophy is that like, if you're letting interest rates dictate your investing, you're thinking about it all wrong. And I know you would agree with me. It's just like, that's such a newbie approach to thinking about real estate because you're just taking such a linear, singular view of how real estate really operates. It's like, look, interest rates are a point in time. And if you think interest rates are high now, like look back into the 80s where interest rates were at like 18 and 20%, right? And people are still investing then. Interest rates are a point in time. I never encourage people to buy negatively cash flowing properties. I'm personally buying a lot of properties that are break even because I know that rents go up every single year. I'm getting huge tax benefits from buying real estate. I'm still using leverage, and I'll do things like cost segregation, accelerated appreciation. That's not the average investor, but that's also coming into play. But just generally speaking, real estate is like, you could always refinance your properties in the future. It's highly likely that at this point in time, in the next 1 to 3 years, rates will likely be lower. But what happens when rates go lower? There's more buyers, there's more competition, prices go up. You don't want to buy during those times, right? Like you want to buy now where you can get better deals to be able to, even if you have a higher interest rate that you can potentially refinance in the future, that you can get a better deal on now, right? It's all about, if no stock investing with dollar cost averaging, like not the exact same, but kind of the same with the idea of buying real estate, like be consistent in your portfolio and optimize it every year from a debt perspective. So I don't know. Again, you better cut me off. I could go on so many tangents.
No, I agree. There's a saying, right? The best time to plant a tree was 20 years ago, but the next best time is probably today or yesterday. So yeah, I definitely agree. And I would say continue to buy real estate, even in high interest rate environments. Be creative about it. I have seen a lot of people shy away from, investing in real estate where the rate of return is lower than your cost of capital, because then you're in a negative leverage debt situation, which isn't optimal. But again, over time, if you can hold on to it, and it is a long-term play, you can refinance.
Well, it's pretty hard to not make those. And just to continue on that point real quick, it's pretty hard to be in that scenario that you just, outlined if you truly understand how real estate works, right? Like once you factor in even like removing cash flow in your cash on cash return, if that's zero, just owning an asset that you get to put a portion down, like real estate is such a beautiful concept, right? Because when you're using leverage, especially, leverage just makes everything that much better. We're using leverage responsibly. But if let's say, if you have $20,000 to invest, you throw it in the stock market, it has a 5% return, you have $1,000 at the end of the year. You had a true 5% return. Now you have $21,000, right? Real estate, you put $20,000 down, you leverage it to buy a $100,000 house. You have the same 5% appreciation. That house is now worth $105,000. That's $5,000 worth of equity. Now you have $25,000 worth of equity. $5,000 divided by $25,000 is a 25% return. That's just a modest appreciation Then you have the debt pay down, right? The tenant is literally paying off that loan for you. And then that adds another return on investment. Then you have the tax benefits, which everyone gets just as normal investment. That adds an additional return on investment, right? So there's all these things that compound. Like, yeah, time is to your advantage the longer you own real estate. But real estate is such a beautiful concept because you get to put a small portion of money down to have 100% of the income and the benefit from owning an asset that you 100% control, that you borrow money from someone, i.e. the bank, the majority of the money to acquire it, that someone else pays that loan off, the tenant, right? So it's just this, you get this because you have 5 decades of family experience in this. But that's my rant.
Yeah, and people often forget about the principal pay down when they're calculating the return, which is a forced form of savings, if you will, look at it like that. Let's talk about evaluating new markets for investment. What metrics matter to you the most?
And this is our formula. We really it's not secret sauce. It's not overly complicated. We really try to adhere to the fundamentals of real estate because this is what works and is what has worked for centuries in our country, right? Real estate investing is like one of the oldest forms of investing because you're investing in human necessity, housing. Housing has always been a necessity, right? And since we've had housing, there's been landlords. So for us, we want to be in growth markets. We want to be in areas that are landlord-friendly, that are legislatively, favorable to landlords. We want to be in areas that are tax favorable, both from an income tax, but also from a real estate tax perspective. We work a lot in the Midwest and the Southeast because of this. We want to be in areas that are below the median house price point in the U.S., which is roughly $400,000. So we want to be, there's a huge affordability issue in the U.S. We want to be in areas and deficit of housing, right? We have a deficit of like 7.5 million houses or whatever. So we want to be in areas that are below the median house price point, below in areas that have an undersupply of housing. We want to be in areas that have a diversity of industries, not just in areas, say, reliant on automotive or oil and gas or as a main employer or government. We want to be in areas where you see population and economic growth. And these are all like, there's check boxes for all of these, but there's a lot of other things to consider as well. Like we want to be in an area where the rent to price ratio is attractive enough to have positive cash flow. So we'll work in areas like Indiana, Missouri, Ohio, and the Midwest. We'll work in areas in Tennessee, Southeast a lot with Alabama, Carolinas, Florida, Georgia, Texas, even though property taxes are high there. So those are some of the areas that we try to focus on. And then we have, on a microeconomic scale, we have people attending city planning meetings, seeing where the new jobs and transportation. We would like to be sometimes in this, what we call secondary markets, like suburbs around a large metro area. Like outside of Orlando, for example, is a perfect area where there's good affordability, good cash flow, less regulation, and still high demand versus like we're in Orlando proper when it works. So, I mean, those are just some of the things we're looking at.
Yeah, nice. Thanks for sharing that. Tell us, I guess, about maybe a little bit about the evolution of your own portfolio. What have you learned scaling across different asset classes? Because I myself am only in residential, but I know that you guys do more than just residential.
Yeah, so as rent to retirement, we mainly focus on residential, and I think that's the best starting point for everyone. Again, it's the most sustainable asset class in real estate, less volatile, and just most predictable. Again, because you're providing housing for people, and it's a huge need. However, over time, we've personally scaled a lot to own a lot of commercial. The majority of our holdings today is in commercial, retail, and multifamily. However, about 30% is still and always will be in residential. And then we've also bought a lot of like high-end short-term rentals, and we're having a lot of fun with those because those are like lifestyle assets, that we also get to use. And we run cost segregation studies and accelerate the depreciation on all of those assets. That's a big idea behind purchasing those. But and that's really been accomplished, Yoni, through 1031 exchanges and like scaling up, right? We started in single family. And this is, out of all the people I've talked to that are super successful in real estate, like this is just the typical stepping stone path, right? They usually start in residential. And again, most people do still maintain a strong portion of their portfolio in residential. And then as they scale, they'll just trade up, the monopoly game. Well, they'll trade up into larger asset classes, 1031 exchange, reset some depreciation, and maybe kind of try out these other things as well, which is the same process for us.
Yeah, that's cool. I'm working on a little short-term project right now, so I'm excited to see how that helps with accelerated depreciation. Tell us, I guess, a bit about the biggest mistakes that you've seen people make when they invest in turnkey real estate.
And just to define turnkey for the audience, because this is kind of a buzzword out there. And so just to be clear and intentional on what we mean when we say turnkey is, first, we identify markets like we just talked about that fit our buy box, and where we see, predictability and scalability over time, and where people can make smart investments. And then where we're talking about either a newly built, majority of what we do, like 80% is new construction, or a fully renovated house that's leased and managed by our team in a growth market. Like, that's what we mean as turnkey. Mm-hmm. It doesn't mean it's completely hands off. It doesn't mean it's risk free. And so one of the biggest issues that I see with newer investors, turnkey tailors towards a lot of different types of investors, but it does tailor towards new investors that have never bought property, which is great because it's an easy stepping stone for them to get in, where it's not a huge risk. It's not a huge time suck. It doesn't require a significant amount of capital. It also fits for people that live in expensive markets, their local market doesn't make sense, or busy professionals that love real estate. They don't want to manage the properties, right? Like, just like with you guys, I'm sure you cater to a lot of those same investors. But sometimes a newer investor comes in and thinks they see a pro forma for year one. Pro forma is always year one expectations or analysis. And they say like, oh, this property is going to perform forever and I'm going to receive a check in the mail with no issues ever. And then, they own the property. And some people do for many years, but the reality is like, at some point you're going to have issues, right? At some point you're going to have management. You're going to have or tenant issues where you need to do maintenance and, tenant repairs or vacancy or evictions. Like, those things are real. That doesn't mean you have to deal with them, but like, some people just lose sleep over the uncertainty around that. So setting right expectations with people is very important. Other mistakes would be that, maybe people don't go through proper due diligence, or they don't you got to learn real estate. Even if you're investing in a somewhat passive approach, like, you still need to have a plan. You need to have a strategy. And that's what we try to work with our investors on. You need to understand the tax side. You need to understand the financing side, the lending. You have to qualify for loans. And so, just preparation. Some people want to be too complacent. Like, they're used to investing in the stocks where they just, whether it's their manager or them just, doing index funds or whatever, and then just never thinking about it. Like, real estate takes a little bit of plan and preparation, and you should, right? You should know what you're investing in. So those are probably some of the mistakes that a lot of early investors make.
Yeah. Tell us, how does Renter Retirement support clients after they, have purchased a property? Because all of those pieces that you just mentioned, come into play. There's maintenance, there's deferred maintenance, there's management, there's rent collection, evictions, leasing, renewals. There's so many moving parts to property management that people often forget about. And when you really want to learn real estate, I think one of the best things to do is to get into property management, because you're learning about all aspects of real estate. But what do you guys do to support your clients once, closing has happened and a new client now owns the property?
Yes, and just to be clear, and hats off to you for being in the management business, because that is a tough business to be in, right? You're dealing with tenants and owners, and sometimes they're both unhappy, and you're in the middle.
The vendors too that are, of course,
right,
supporting us.
But
we're nothing. Without good vendors, we are absolutely nothing.
And you can probably attest to this, Yoni, like, good management is everything, right? For the performance of the asset. You can be in the best market in the world, but if you don't have good management in place, and I would argue to everyone, do not self-manage, right? Some people want to start, they want to self-manage. It's not the best utilization of your time. You're not a professional.
I don't even self-manage.
We
have property managers in our office here that are managing my own properties, and I don't want to self-manage.
It's about systems. Yep. It's about systems, because the best utilization is your time is, how do you scale? Or a lot of people get into real estate because they want to buy more time back. It's like management does the opposite of that, right? So, anyways, to answer your question about, how we support people. So we don't do management, but we do partner and vet local managerial teams in each market that we operate in. We also, just like you mentioned, we personally use them. So you don't have to use them. These are just teams that we recommend. But we certainly stay involved with investors to help them build out their strategy over time, if they do have issues with their local management team who's overseeing the day-to-day operations, we obviously have influence and leverage over them, and we can get involved if needed. But a lot of times I found it's just about education about, all right, this popped up. How do we deal with this if it's an issue? Or the bigger picture conversations are like, cool, I bought, properties, I'm out of cash. Like, do I sit around and wait until I save up enough money as a down payment? Or, or what are my different loan options, right? A lot of it's just coaching and mentorship. We have lenders that will offer 5% down loans on true investment properties. You can buy true investment property, and there's no PMI on those. Those are portfolio loans held with credit unions, 30-year loans. You can put 5% down. Now, those are hard to make cash flow with only 5% down, but that may be a good fit. Or talk about partnerships or HELOCs or 1031 exchanges or self-directed IRAs. It's a lot about the strategy and planning and building long-term relationships with people to really help them scale over time, which is the name of the game. But I love working with investors because real estate investing is a lifelong journey. And when you have someone that you're helping kind of plan out their financial future, like it's a long-term relationship, right? And so that's the way we approach it. We have our whole academy program, which is, people don't have to participate in that, but it's an educational and mentorship program where we actually help you build out that plan as a lifetime membership thing. So again, we try to stay involved with our investors, and no one retires off of just one house, so.
Right. Yeah. Love that. Where do you see greatest opportunity for new investors right now?
I would say that there's a plethora of opportunity. And what I would say as well is that just because I think there's opportunity in a particular market does not mean it's the right opportunity for everyone. Because real estate's such an individualistic thing. And that's what makes it exciting, is that every single person has different goals, criteria, strategies, resources. They have different unique creativity they can bring, and where they can create opportunity where other people may not be able to, because of their skill set or influence. So, but in general, I think a lot of what we talked about previously with the market being what it is today, we're in our third year now. It's been 3 years since we've seen elevated interest rates, and we haven't really seen that much relief. Now we're all anticipating that we likely will. I think we can also bank on 100% bonus depreciation coming back. That's huge, even though it hasn't officially happened yet. But right now we're seeing the retail market still being relatively slow. However, I will say that Q1 in 2025 has been the most progressive sales market that we've seen over the past 3 years. So I think it's starting to shift back to a seller's market very slowly, but it's still a buyer's market. That means you should be able to negotiate better deals. There's plenty of markets, especially, like I said, the markets that we specifically focus on. We still see double-digit appreciation, both in rents and home prices every single year. It's just about supply and demand. Whereas that's the biggest, interest rates don't drive economics, it's supply and demand. Where is the biggest deficit of housing? Where are people moving? Because if they need housing and you're in those affordable price points that we are, like, that's going to be the biggest indicators. So I think there's a lot of opportunity, especially on the new construction space, where people can come in and negotiate good deals. You get builders to buyer rates down to, sometimes we see down to like 3.99% on a 30-year fixed loan. Like, that's huge, right? Or you can get cash back. Like some of the builders we work with will do 10 to 15% either equity or cash back. So that's true equity, where you can actually have part or potentially all of your down payment paid. Those things won't last when we have lower interest rates and more of a, there's less competition to sell inventory. So again, I encourage people to look for the opportunity that fits your goals and take action now, regardless of interest rates, because there's always opportunity. The most successful investors, Yoni, are the people that are investing in any market and cycle and finding ways to be successful, not letting the market dictate when they're investing.
Right. Yeah. You may have just answered that, my next question by, giving that little tidbit there. But for someone who's listening, who's on the fence about starting, what is your biggest piece of advice for them to get moving forward?
Yeah. Stop being in the, perpetual analysis paralysis mindset, of reading and listening. Go out and do it. Your first property is not going to be the most important one financially, but it is going to be the most important one mentally and emotionally. Or maybe it's your first one out of state, or maybe you've had a bad past experience with real estate, or maybe it's just been a few years and you don't know what to do. There's plenty of deals to be had right now. There's plenty of excellent deals to be had. Go out and do it, right? Just stop thinking about it and do it. Real estate's a holding place, for money. You're not going to lose your shirt. You're not buy smart. And if you're adhering to the fundamentals of real estate, which is, hey, at the end of the day, this isn't rocket science, people. Invest in a good market, have a criteria, have your buy box, invest in a good market with good teams. You're not going to go wrong, right? Like, invest for the long term. You're not trying to flip house. Well, maybe some people are flipping a house, but like what we're talking about is good old buy and hold rental real estate.
Buy and hold.
Yep.
Yeah.
And if you can buy good markets with good teams that generally fit your goal, like, buy it and forget about it. Let time do what it does over time, but just get in the mindset, force yourself to do that. Set yourself a goal, say buy your next property in the next 90 days or less. There's plenty of opportunity. I'm sure, Yoni, you guys have plenty of opportunity, as do we, to help people take that next step.
Yep. Love it. Love it. Love it. Thank you so much. Guys, you've heard it from the expert, Zach Lemaster from Rent to Retirement, the CEO. Zach, thank you so much for being here today with us. Really appreciate it.
It's been a pleasure. Thank you, Yoni.
Thanks for listening to the Same Day Podcast. Tune in to a new show each week and be sure to subscribe to get future episodes.